James is 62 years old. He has been contributing to his 401k for 29 years. He checks his statement every quarter. Everything looks normal. He has no idea a deadline is 6 months away. There is a 401k rule change happening at the end of 2026 that most Americans have never heard of. When December 31 passes, two windows close permanently. Neither one reopens. Two rules, both from the Secure 2 Act passed in 2022, both tied to this specific deadline. One creates a temporary advantage. One permanently removes an option. The Secure 2 Act passed in December 2022. It changed retirement rules across the board, but most of the biggest changes phase in gradually. 2026 is when two of the most important ones land simultaneously. If you are between 60 and 63, both rules apply to you directly. If you earn over $145,000, Rule 2 permanently changes how your contributions work. If you are neither, this affects your strategy and someone you know. The difference between knowing this and not knowing it, $10,000 to $30,000 in additional tax-advantaged contributions that cannot be recovered once the deadline passes. Rule 1 first, the super catch-up. This is the one that creates a window, and the window is specifically for ages 60 to 63. Standard catch-up for age 50 plus $7,500. Super catch-up for ages 60 to 63, $11,250. An extra $3,750 per year above what everyone else can contribute. Available only in this specific age window. Congress designed this specifically for the ages 60 to 63 window, the last high-earning years before most people reduce hours or retire. It is a targeted catch-up mechanism, and it is available right now. James is 62. He is in the super catch-up window right now. He has this year and next year. After he turns 64, the enhanced amount drops back to the standard catch-up permanently, $3,750 extra per year. Over 4 years, $15,000 more contributed. Compounding at 7% for 10 more years, that $15,000 becomes approximately $29,500. Not using the super catch-up is leaving $29,500 on the table permanently. Every year of delay inside this window is a permanent loss. If you are 63 right now and have not used the super catch-up, this is the last year it will ever be available to you. Lisa turned 64 last month. She just aged out of the super catch-up window. She did not know it existed until 2 weeks ago. The window closed permanently. It will not reopen. 3 conditions for super catch-up eligibility. You are between 60 and 63. You have access to a 401 KEC, 403B, or 457B. Your plan allows catch-up contributions most do. All 3, you are eligible right now. Log into your 401 KEC portal. Find the catch-up election section. Increase it to $11,250. Confirm it reflects in your next paycheck. Under 15 minutes. Available until the 31st of December, 2026. At a 24% tax bracket, that extra $3,750 reduces your tax bill by $900 in year 1. The super catch-up is partially self-funding. The government effectively pays a portion of it. James contributes $34,750 in 2026. But at his 24% bracket, his tax savings mean he only effectively spent $26,410. The government covered $8,340 of his retirement savings. Rule 2. The one that permanently removes an option millions of Americans are currently using without knowing the deadline is less than 6 months away. Pre-tax 401k. You contribute before paying income tax. You get the deduction now. You pay taxes when you withdraw. Roth 401k. You contribute after tax. You pay taxes now. Withdrawals are completely tax-free. Both have their place. Starting the 1st of January 2027, if you earn more than $145,000 from your employer, all catch-up contributions must go to Roth. You lose the choice permanently. 2026 is the final year to choose pre-tax catch-up. The $145,000 threshold is based on your W-2 from the prior year with that employer. Pull last year's W-2 right now. If you earned over $145,000, this mandate applies to you. Starting in 2027, pre-tax catch-up is not wrong. For someone in a high bracket now expecting a lower bracket in retirement, it has always been the smart choice. That choice disappears for high earners after the 31st of December 2026. At a 32% bracket, pre-tax catch-up saves $2,400 in taxes this year. If your retirement bracket is 22% pre-tax, wins over your lifetime. If rates rise or you have high retirement income, Roth wins. The math depends on your specific situation. After the 1st of January 2027, the pre-tax catch-up option for high earners is permanently removed. The current year tax deduction on that money permanently gone. If pre-tax catch-up was your strategy, 2026 is the last time you can use it. James earns $180,000. He is 62. Both rules apply to him simultaneously. In 2026, he can use the super catch-up and make his final pre-tax catch-up contribution. He has a small window to maximize both. Same total contribution in both years. But in 2026, James gets $11,120 in immediate tax savings on the pre-tax portion. In 2027, the catch-up becomes Roth, no current year deduction. The net cost rises by $11,120 for the same contribution. The Roth mandate is not purely bad news. Roth grows tax-free forever and has no required minimum distributions. But for someone who specifically needed the current year deduction, removing the choice costs real money. If you earn under $145,000, Rule 2 does not directly affect you. You keep the pre-tax catch-up choice permanently. But Rule 1, the super catch-up, still applies if you are between 60 and 63 right now. The mandatory Roth catch-up was originally set for 2024. The IRS delayed it twice, giving employers and plan administrators time to update systems. That grace period ends the 31st of December 2026. There are no further delays announced. 3 situations, 3 different action plans. Find yours because the right move depends entirely on which category applies to you. Situation A, ages 60 to 63. Call HR or log into your plan portal. Increase catch-up to $11,250. Confirm the next paycheck reflects the change. Every year you are in this window. Matters do not leave any of them unused. Situation B earns over $145,000. Pull your prior year W-2. If you prefer pre-tax catch-up for the current year deduction, use it in 2026. This is the final year you have that option. If you already prefer Roth, the mandate will align with what you were doing anyway. Situation C. All other 401k holders. Maximize the base, $23,500, contribution first. If you are over 50, use the standard $7,500 catch-up. The 2026 rules do not create a crisis for you, but contribution maximization always matters. The full checklist. Check your age, check your income, log into your portal, review your election, increase the amount, confirm the next paycheck. 6 steps. Do all 6 before the 31st of December 2026. Roth IRA contributions are completely separate from 401k limits. If your income allows, use both simultaneously. The $7,500 Roth IRA limit and the $34,750 super catch-up limit are independent of each other. Roth IRA has income limits. Single filers, full contribution under $146,000. Phase out to $161,000. Above that, the backdoor Roth IRA is the workaround most high earners use. A 6-2 year. Old using the super catch-up for 2 remaining years contributes $22,500 extra. Compounded at 7% over 10 more years. That is $44,200 in additional retirement value. The cost of not knowing $44,200, James logs in, increases his catch-up to $11,250, confirms the change for the next paycheck. It takes 11 minutes. The compound growth begins with the next payroll cycle. If you cannot fully max out the super catch-up increase by whatever you can afford, even $1,000 more per year inside the window beats zero. The base contribution comes first. Catch-up is secondary. Pre-tax versus Roth math is personal. It depends on your specific tax bracket now and your expected bracket in retirement. A fee-only financial advisor runs this calculation with your actual numbers. The rules here are general. Your situation is specific. Social Security faces projected shortfalls. Average retirement savings at 55 are $87,000. Most Americans are working longer than planned. Every tax-advantaged dollar not contributed today is a dollar your future self cannot recover. Lisa and James. Same age, same employer, same income. The only difference James knew about the window. Lisa found out 1 year too late. The information gap cost her $44,000 in retirement value. The most important single action from this video. Log into your 401 KEC portal this week. Check your catch-up election. One screen, one change. Permanent impact. The 6 numbers that matter. Base limit, $23,500. Standard catch-up, $7,500. Super catch-up, $11,250. Roth mandate, threshold $145,000. Roth IRA, $7,500. Deadline, the 31st of December, 2026. Screenshot this. After 2026, 2 permanent changes to plan around. High earners use Roth, catch-up only. Ages 64 and above, return to the standard $7,500. Build your contribution strategy around both from 2027 forward. Think of one person who is between 60 and 63, or one person earning over $145,000. Share this video with them before the year ends. The information gap cost Lisa $44,000. It does not have to cost someone you know the same. This is educational content, not tax or financial advice. Verify all limits and thresholds with your plan administrator or a qualified tax professional before making changes to your contributions. The gap between maximized and minimized 401 KEC contributions becomes visible over a lifetime, and it is not recoverable after the contribution years have passed. Your retirement account does not care whether you knew about the deadline. The window closes anyway. Now you know. Subscribe to Wealth Construct. Every week, real financial mechanics most people learn too late. This one, you learned before the deadline. Are you in the super catch-up window right now? Drop your age below. I want to know how many people this reached before the December 31 deadline. Quick reference by age. Under 50, maximize the base. 50 to 59, use the standard catch-up every year. 60 to 63, you are in the window right now. The super catch-up is available. 64 and above, the enhanced window has closed. If you expect a lower bracket in retirement, pre-tax wins, and 2026 is your last year to use it. If you expect equal or higher rates, Roth wins, and the mandate aligns with your strategy. If you are unsure, Roth is the safer default, because tax-free growth is guaranteed. The real math, always. I'm Professor Alex. This is Wealth Construct. Wealth Construct. The real math, always.